You know what's interesting about the way most traders talk about losing money? They never blame themselves. And I don't mean that as a criticism, I mean it as an observation, a genuinely curious one, about how the human mind handles financial pain, because the language traders use when a trade goes wrong is almost always the language of external forces. The market was irrational. The news came out of nowhere. The algos hit my stop on purpose. The Fed surprised everyone. My broker had slippage. The timing was off. Always something out there. Always something that isn't you. And here's the thing, sometimes those things are true. Markets are irrational. News does come out of nowhere. Surprises happen. Slippage is real. But if you've been trading for any meaningful length of time, and you sit down quietly, without your ego in the room, and you go back through your losses, the real ones, the ones that actually hurt, the ones that kept you up at night, what do you find? You find yourself. Not always, but more often than you were willing to admit at the time. That discovery, that specific, uncomfortable, clarifying moment when you stop seeing the market as the thing that's working against you and start seeing yourself clearly, that moment changes everything. Jesse Livermore had that moment. And the story of when it happened, how it happened, and what it cost him to finally arrive at it, that story is the foundation of everything he ever understood about markets, everything he ever wrote, every trade that made him legendary. It starts not with a win, not with a flash of brilliance. It starts with a loss so complete, so humbling, so impossible to explain away that he had nowhere left to look but inward. And what he found there changed the course of financial history. He had been in markets long enough to believe he understood them. That's the setup. That's always the setup. Not ignorance, knowledge, not inexperience, experience. The dangerous moment in any trader's development is not when they're new and humble and aware of how much they don't know. The dangerous moment is when they've been around long enough to feel like they've got it figured out. Livermore had been trading since his early teens. He had made real money, significant money by any measure, in the bucket shops of Boston and New York. He had developed what felt like a genuine feel for the tape, a sense for when stocks were about to move, when conditions were aligning, when the line of least resistance was shifting in a way that created opportunity. He believed he had an edge, and for a while he did. But here's what happens when you believe you have an edge, and the market confirms it repeatedly. You stop questioning the edge. You stop examining the process. You start to conflate the quality of your thinking with the outcomes it's producing. And when outcomes are good, when the trades are working, when the account is growing, when every move you make seems to validate the framework you've built, the feedback loop stops being honest. You become, without realizing it, less rigorous, less patient, less willing to wait for the conditions that generated the edge in the first place. Because the confidence that comes from a winning streak doesn't feel like overconfidence. It feels like clarity, like you've finally arrived at a level of understanding that the market is now rewarding. Livermore arrived at that feeling, and then the market took everything, not in a single dramatic moment, though the losses were dramatic enough. Over a period of time, through a series of decisions that each made sense in isolation, but collectively represented a complete abandonment of the discipline that had built his stake, he gave it back. All of it. And then some. He was broke. Genuinely, completely, humiliatingly broke. In debt. Without capital, without the ability to trade, sitting with nothing but time and the wreckage of what had been, by any reasonable standard, a successful trading career up to that point. And in that silence, in the particular silence that only comes when the noise of markets is no longer available to distract you, he started to think clearly for the first time in a long time. Here's what he found when he looked back honestly. Every significant loss in his recent history traced back to the same source. Not the market, not bad luck, not irrational price action or unexpected news or any of the external explanations that had felt so compelling in the moment. Every loss traced back to a decision he had made, a specific, identifiable decision that deviated from what he knew to be correct, from the principles he had developed through years of observation, from the rules he had built and that had built him. He had held positions past the point where the tape was telling him to exit. He had added to trades that were moving against him because he was convinced his analysis was right and the market was wrong. He had traded in conditions that didn't meet the criteria for high-probability setups because he was impatient, because he felt like he should be doing something, because the account was there and the market was open and the itch to trade was stronger than the discipline to wait. None of these decisions felt wrong in the moment. That's the part he kept coming back to. Every one of them felt justified. Every one of them came with a narrative, a story he told himself about why this particular situation was different, why the usual rules didn't quite apply here, why his read on this specific trade was sound enough to override the normal criteria. The stories were convincing. He had convinced himself with every one of them, and every one of them had been wrong. Not wrong in the way bad analysis is wrong, not factually incorrect, not missing information. Wrong in the deeper sense of being generated by a mind that was operating under emotional pressure rather than clear judgment. Wrong in the sense that they were the decisions of someone who needed a specific outcome to be true and had constructed a justification for believing it was. This is not stupidity. This is not weakness. This is what the human mind does under the pressure of money and ego and the relentless feedback of financial markets. It constructs stories, it finds reasons, it justifies. And the smarter you are, the more capable you are of sophisticated analysis, the more convincing the stories become. Livermore understood this about himself with a clarity that took real courage to maintain, because it would have been so much easier to blame the market, to say the conditions were unusual, to point to the specific external factors that contributed to each loss and build a case for why none of it was really his fault. He didn't do that. He sat with the harder truth. And the harder truth was this: the market had not worked against him. He had worked against himself. I want to stay here for a moment in this specific insight because it's the one that most traders never fully arrive at, and the ones who don't arrive at it never quite figure out why they can't reach the consistency they're capable of. The market is not your enemy. Say that again. Feel it, not as a platitude, as a genuine reorientation of how you understand your relationship with markets. The market is not designed to take your money. It is not aware of your positions. It does not know where your stop is, despite what it sometimes feels like. It does not move against you personally. It does not have an agenda with respect to your account. The market is simply the aggregate behavior of every participant, every fund, every algorithm, every retail trader, every institution, expressing their collective judgment about value and direction in real time. It is information, constantly updating, constantly incorporating new data, constantly reflecting the shifting balance of supply and demand among millions of participants. That information is neutral. It doesn't favor you or work against you. It simply is. What works against you, what has always worked against you, in every losing trade you've ever had, is your response to that information, your interpretation of it, your decisions about what to do with it, your emotional reactions to the way it unfolds. The market showed you the price. You decided what it meant. You decided what to do. You decided whether to enter, hold, add, exit. Every decision was yours. And when those decisions were wrong, when they deviated from sound judgment, from established rules, from the honest reading of what the tape was actually telling you, the losses that resulted were not the market's doing. They were yours. This is not a harsh judgment. It's a liberating one. Because if the market were actually working against you, if the losses were genuinely external, genuinely caused by forces beyond your control, there would be nothing to do about it. You'd be at the mercy of something you couldn't influence. But if the losses are yours, if they trace back to decisions you made, patterns you repeat, psychological tendencies that distort your judgment at critical moments, then they're addressable. You can work on them. You can understand them well enough to interrupt them. You can build systems and structures that reduce their influence. The enemy being you is actually good news. Livermore eventually understood this. Not quickly, not without cost. But he understood it deeply enough that it became the foundation of everything he rebuilt. Let me tell you what he did with that understanding, because this is where the story gets interesting. where it stops being about one man's losses and becomes about a framework that has outlasted him by almost a century. After the losses, after the humbling, after the silence, after the honest accounting of what had actually happened and why, Livermore went back to the beginning. Not to his beginning in markets, but to the beginning of his thinking about markets. To the observations he had made in the bucket shops before he had enough success to become careless with the process that generated it. He went back to the tape, not with a system, not with a set of rules he was determined to follow, with a question, a genuine, open, humble question. What is the market actually telling me? Not what do I believe, not what does my analysis suggest, not what does my gut say. What is the tape, the actual real-time behavior of prices actually communicating? He started watching, really watching, with the patience of someone who has nothing left to lose and therefore nothing left to protect. No ego on the line, no track record to defend, no need for the market to validate a thesis because there was no thesis, just observation. And what he saw watching that way was something he had seen before but stopped seeing when success made him confident. He saw that the market, when you stop arguing with it, is remarkably transparent. It communicates direction. It communicates strength and weakness. It shows you where the energy is, where the pressure is, where the line of least resistance lies. Not perfectly, not without ambiguity, but clearly enough, if you're watching without agenda, to give you a genuine probabilistic edge. The tape doesn't lie. That was one of his most repeated convictions. Not because markets are efficient in some academic sense, they're demonstrably not, but because the tape reflects what is actually happening, in real time, regardless of what anyone believes should be happening. And what is actually happening is more useful information than what should be happening. He rebuilt his trading on that foundation, on the discipline of listening to the market rather than arguing with it, on the practice of letting the tape be the authority and his analysis be the hypothesis, something to be confirmed or rejected by price action rather than something to be defended against it. And the results, when he rebuilt on that foundation with that discipline, were the results that made him legendary. Now I want to bring this to you, because this isn't a history lesson. At least it's not only a history lesson. Think about the last time the market moved against your position, the last time you were in a trade and the price went the wrong way. What was your first reaction? Not your second reaction, not your considered response after you'd had time to think. Your first reaction. The gut-level, immediate, unreflective response to seeing red numbers in a position you believed in. For most traders, and I'd include myself in this, the first reaction is something in the neighborhood of resistance, a pushback against what the price is doing. An internal voice that says something like, "That's wrong, that doesn't make sense, this stock shouldn't be trading here, the market is overreacting, the move is temporary, it'll come back." That voice is not analysis. It's ego. It's the part of you that had a thesis and doesn't want the thesis to be wrong. The part that has money on the line and has therefore become emotionally invested in a specific outcome. The part that will construct any narrative necessary to avoid the discomfort of admitting that the trade isn't working. And here's the thing about that voice. It's not stupid. It's not always wrong. Sometimes the market does overreact. Sometimes the move is temporary. Sometimes the stock does come back. But here's what Livermore figured out. Here's the insight that separates how he eventually thought about this from how most traders think about it. It doesn't matter. It doesn't matter whether that voice is right or wrong about the specific trade. What matters is what you do while the voice is talking. Because while the voice is constructing its narrative, while it's arguing with the tape, finding reasons to stay in, building the case for why this is different, the position is doing something. The price is moving. The loss is either staying manageable or growing into something that isn't manageable anymore. And the time you spend listening to the voice, the time you spend in that internal argument, is time you're not spending doing the only thing that actually matters, evaluating what the tape is telling you and deciding whether that information changes your position. Not whether the stock should be here, whether the tape is telling you something real about where it's going. Not whether your analysis was correct, whether the market is confirming or denying the thesis right now, today, in the price action you can actually see? That's the question. And it requires a quality of attention, a willingness to hear an answer you might not like, that is genuinely hard to maintain when money is on the line. Livermore spent his career developing that quality of attention, losing it when success made him careless, rebuilding it when failure made him honest, losing it again, rebuilding again. The process was not linear. The mastery was not permanent. But the core understanding that the market is not the enemy, that the enemy lives in your response to the market, that understanding, once genuinely arrived at, changes the way you trade in ways that are permanent and cumulative. There's something Livermore wrote that I come back to more than almost anything else in his body of work. It's not a dramatic statement. It's not one of his more famous lines. It's almost a throwaway, something he mentioned almost in passing in the context of explaining something else. He wrote about the experience of being in the market without ego. He described it as a kind of freedom, not the freedom of certainty. He was always clear that certainty in markets is an illusion, but the freedom of not needing to be right, of being willing to be wrong, quickly and without drama, and to move on to the next opportunity with your capital intact and your judgment unclouded. He described traders who had this quality as operating with a kind of lightness. They didn't grip trades. They didn't fight the tape. They entered with conviction and exited without remorse, because the exit wasn't a defeat. It was just information. The market had told them the thesis wasn't working right now. Okay, they'd wait for the next one. And the traders who didn't have this quality, who approached every trade as a confrontation between their analysis and the market's behavior, who held positions like they were defending territory, who took losses personally and therefore took too long to take them. Those traders, however talented, however analytically capable, were operating with a drag on their performance that no system could overcome. The drag was their relationship with being wrong. Because being wrong is inevitable in trading. It happens to everyone. It happens to the best traders in the world on a regular basis. The question is never whether you'll be wrong, you will be. The question is, what being wrong costs you? And what it costs you is almost entirely determined by how quickly you recognize it and how cleanly you accept it. A loss taken quickly, at a predefined level, before it has time to grow and before your ego has time to construct an elaborate defense of the position. That loss is just the cost of doing business. It's the price of being in the game. It's small enough that it doesn't affect your next decision. A loss allowed to grow because you couldn't bring yourself to admit the trade wasn't working. That loss does something beyond the financial damage. It changes your state. It creates pressure. It makes the next decision harder, because now you're not just trading the market. You're trading with the weight of the last trade on you, the need to get it back, the distorted risk tolerance that comes from being down, the anger or despair or desperation that colors every decision you make until the account recovers. Livermore understood this cascade. He had lived it. And his conviction, born from that experience, was that the single most important thing a trader could do for their long-term results had nothing to do with finding better setups or developing better analysis. It was developing a healthier relationship with being wrong. Let me tell you what that looks like in practice, because it's easy to say accept your losses quickly and much harder to actually do it when you're in a position and the internal voice is talking. Livermore's practical answer was architectural. He built the acceptance of losses into the structure of the trade before the trade was placed. Before he entered any position, he identified the specific price level that would tell him the trade was wrong. Not, this is where I'll think about exiting, the specific level where the thesis was definitively invalidated, where the market had done something that, by his read, changed the probability of the trade working. That level was decided in advance, in a calm state, before money was at risk, before the internal voice had any stake in the outcome. And then, and this is the critical part, that level was binding. It was not a suggestion. It was not a starting point for negotiation when the price approached it. It was the answer to the question he had already asked himself, answered honestly, and committed to acting on. When the price reached that level, the trade was over. Not because he had decided in the moment that the trade was over. He had decided weeks or days or hours earlier, in a state where his judgment was unclouded by the emotion of an open position. He was just executing a prior decision, a good decision made by a clearer version of himself in a calmer moment. This is subtle, but it's everything, because the decision to exit a losing trade at a predetermined level is categorically different from the decision to exit a losing trade in the moment the loss is real and the voice is talking. The first decision is made by your rational mind, operating on principle, without the distortion of real-time emotional pressure. The second decision has to compete with every psychological force Livermore identified as the enemy of sound trading: hope, fear, ego, the need to be right, the reluctance to admit a mistake. When you predetermine the exit, you don't have to fight those forces in the moment. You've already done the fighting in advance under better conditions. The exit is just the execution of a prior commitment. That's not just a risk management technique, it's a psychological architecture, a way of protecting your future self from the worst impulses of your present self, from the version of you that's in the heat of a losing trade and desperately wants the narrative to be different from what the tape is showing. There's a version of this insight that goes deeper than trading, and Livermore touched on it, not in explicit terms, not as a philosophical digression, but it's there in the subtext of everything he wrote about markets and human nature. The enemy is not out there. The enemy is the story you tell yourself about what's happening out there. The market shows you a price, that's all it does. A number. Moving up, moving down, staying still, that number is neutral. It doesn't have meaning until you assign meaning to it. When you assign meaning, when you interpret that price as the market is working against me, or the market doesn't understand this stock, or the market is being irrational, you've stopped receiving information and started generating narrative. And narrative, in the context of an open position with real money at risk, is almost always self-serving, almost always constructed to support whatever outcome you need to be true. The discipline Livermore built, the discipline that produced his greatest trades, was the discipline of delaying that narrative, of staying with the information a little longer, of asking what the tape is actually saying before deciding what it means, of being genuinely willing to receive an answer that contradicts your thesis. That willingness, that genuine, practiced, consistently applied willingness to be wrong, is what separated him from the traders he watched fail around him. Not intelligence, not superior analysis, not better information. The willingness to be wrong, quickly, cleanly, and without drama. It took him years to develop it, cost him everything at least once before he did. And even after he developed it, he lost it periodically, in the way all of us lose our best qualities under pressure, and paid the price for losing it. But he kept coming back to it, kept rebuilding it, kept insisting through his writing and his trading that it was the thing, the foundational thing, the one without which everything else in the framework was incomplete. Here's what I want you to take from this episode. Not a technique, not a rule, a reorientation. The next time a trade moves against you, and it will because that's what markets do, I want you to try something before the internal voice gets going, before the narrative starts building, before the ego starts defending the position. Just pause, one breath, and ask one question. What is the tape telling me right now? Not what should the tape be telling me. Not what do I believe the tape will tell me tomorrow. Not what does my analysis say the tape should be saying. What is it telling me right now? And then listen. Actually listen, without the agenda of a position, without the need for a specific answer. Just receive the information and let it be what it is. If it's telling you the trade is working, great. You have confirmation. The probability is being validated in real time. If it's telling you something else, if the price is doing something that contradicts your thesis or failing to do something your thesis required, that's information too. Equally valid, equally real. And the quality of your response to that information, your ability to receive it without distorting it, to act on it without the delay of self-deception, that quality, more than any system or setup or analytical framework you'll ever develop, will determine your long-term results in markets. Livermore figured this out the hard way. Twice, maybe more. He wrote it down so you might not have to. The market is not your enemy. It never was. If this is landing for you, If something in the way Livermore thought about markets is connecting with something in the way you experience trading, then you're in exactly the right place. Elsie Books and Life goes deep on the traders and investors who shaped how markets actually work. Not the surface level stuff, not the tips and the predictions and the hot takes. The real psychology, the real philosophy, the real story of what it takes to operate in markets at the highest level over the long run. Jesse Livermore is just the beginning. We've got 49 more episodes in this series alone, covering everything from risk management to market reading to the specific psychological traps that end careers. And every one of them goes this deep. Subscribe, leave a comment if something hit home, and share this with someone who needs to hear it, because almost every trader does. The link to Livermore's books is in the description. Reminiscences of a Stock Operator and How to Trade in Stocks. Read them. They're worth more than most trading courses sold today. See you in the next one.